In 2010, General Motors proclaimed it had repaid its Government Lifeline in full. The campaign was a masterclass in narrative control, celebrating a miraculous resurgence. But the headline was a carefully crafted lie. Behind the triumphant ads, newly released Treasury documents told a different story. The $49.5 billion wasn't a simple loan, and its repayment was a financial sleight of hand. The company saved from extinction was now at the center of a new debate. Was this a genuine recovery, or a carefully constructed illusion? To understand the comeback, you first must understand the story they needed America to believe, and why the reality of the government's rescue was far more complicated. It all started the moment the check was written. Early 2009, the collapse wasn't coming, it was here. Sales were in freefall. Credit markets frozen. General Motors was hemorrhaging cash at a rate that made solvency a fantasy. The numbers told the whole story, roughly $172.81 billion in debt against a business that was structurally broken. For the once unassailable titan of American industry, liquidation was no longer a risk. It was the scheduled, mathematical outcome. Weeks away. The machine was winding down. Then came the Lifeline, the Troubled Asset Relief Program, TARP, deployed over $50 billion. Not a gift, not a blank check. It was a high-stakes tourniquet. This was debtor-in-possession financing, the most delicate form of financial ICU. For GM, it meant funding a surgical bankruptcy to let a new GM be carved from the corpse of the old. It bought time. It solved nothing. The pathology, the debt, the bloated structure, the lost market share remained. The money was oxygen, not a cure. And on the factory floor, the sound of that oxygen arriving was silence. Lines shut down. Brands that were Americana itself, Pontiac, Saturn, Hummer, were axed. The workforce was decimated. This was the bottom. The absolute quiet bottom. The capital had stopped the bleeding. But the surgery, the real work of turning a national institution into a viable company, hadn't even been scheduled. And as the world would later learn, the campaign to declare victory was launched years before the first real incision was ever made. The lie was simpler than the truth. The money kept the lights on. But money doesn't fix rot. The first casualty was the leadership team that had steered the company into a financial abyss. They were systematically replaced by a new executive core, overseen by a board with a single mandate. Ensure this never happens again. Not growth. Not market share. Just never again. This new team inherited something less a company than a dysfunctional confederation of brands, factories, and dealer networks, each cannibalizing the others in a fight for diminishing resources. The fundamental question was not how to grow, but what to cut to survive. The answer came fast, and it was the opposite of everything General Motors had preached for a century. The new playbook rejected the decades-long obsession with market share above all else. In a stunning reversal of corporate doctrine, the company downsized. The company was surgically reduced to just 4 core brands, abandoning entire segments of the market it had once dominated. Long-standing, even iconic, nameplates terminated. During the bankruptcy and restructuring, over 1,000 independent dealerships received closure notices. Imagine telling a century-old empire that its salvation lay in becoming less. This was triage on an industrial scale. The internal logic flipped from, how much can we sell, to, what can we afford to build profitably? A profound psychological break from the past. Sacrificing size for solvency. But the amputations had only stabilized the patient, and as any surgeon knows, survival is not the same as a cure. The mechanism for generating actual growth had yet to be invented. The surgery was over. The bleeding had stopped. Now the focus turned to building the muscle. The new playbook wasn't about going bigger, it was about going deeper. The capital, once spread thin across a bloated empire, was funneled back into the engine that had always powered Detroit's profits: full-size trucks and SUVs. This was a strategic moat being dug, dollar by dollar, into the bedrock of their existing advantage. The company poured over $6 billion into U.S. manufacturing since 2025, a staggering sum aimed squarely at the heart of their business. Recent investments of $1.3 billion doubled down on high-margin transmissions and next-generation V8 engines for the Chevrolet Silverado and GMC Sierra. They weren't building the future, they were fortifying the present. The message was clear: generate maximum near-term cash from what customers already wanted, at prices that protected the bottom line. But reinvestment alone doesn't create a moat. The old playbook, flood the lots, discount to move, was gone. In its place was a new discipline. Dealer inventory was tightened to historically low levels, around 47 days of supply. This wasn't an accident, it was a weapon. Scarcity protected pricing power. Incentive spending was deliberately kept below the industry average, severing a lifeline that had drained margins for years. Every vehicle sold now carried more profit to the bottom line, strengthening the financial core. A parallel revenue stream was quietly scaling. Digital services, OnStar, connected subscriptions, generated over $750 million in a single quarter, up 20% year over year. The plan wasn't for a one-time spike. It was to build a recurring engine, targeting a $3.1 billion annual business. The deferred revenue backlog stood at $5.8 billion, marching toward a target of $7.5 billion. The manufacturing investments and inventory discipline had laid a new foundation. They'd turned operational rigor into a weapon. But a foundation is just the start. The real question was whether they could build a new kind of revenue castle atop it, one that earned money even when the factory lines were silent. $184 billion. A figure that would have sounded delusional scrawled on a whiteboard inside bankruptcy court. That's the trailing revenue now flowing through a company that once carried an $82 billion liability on its back. The death spiral didn't just stop. It reversed. The proof lives in the quarterly ledger. Adjusted EBIT hit $4.3 billion, driven by the strategic pivot back to core strengths, reclaiming a 42% market share in full-size pickups, the single most profitable segment in American automaking. This profit engine refilled the treasury. The balance sheet, once barren, now holds $19 billion in cash. A fortress where a crater used to be. That fortress funds the return of value, $164 million in dividends and $800 million in share buybacks in a single quarter. The company that couldn't pay its bills is now systematically rewarding its owners. And the runway ahead projects $9 billion to $11 billion in annual free cash flow. The paradox of this new scale is its discipline. A North American operating margin of 8.6% proves that efficiency, not bloat, is the operating system. Growth without margin is just expensive applause. GM found both. The numbers confirm what the strategy promised: a cash-burning liability transformed into a cash-generating asset, not hope. Engineering, but revenue is only half the equation. The other half is what a company this size does with the capital it's generating, and whether the next move can outrun the forces already gathering at the gate. The turnaround from a government-backed bankruptcy wasn't a miracle, it was a manual, a transferable playbook for any organization staring into the abyss. The first rule is a brutal rejection of corporate vanity. Stop chasing market share. Start defending profit margin. In a crisis, complexity is a cancer. The turnaround didn't begin with a grand vision for the future. It began with a hard reckoning with the present, followed by the operational courage to amputate what was unprofitable. No sentiment. No nostalgia. This act of strategic subtraction is the non-negotiable price of survival. The second rule: concentrate on what's profitable and recalibrate the rest. For GM, this meant a measured capital allocation strategy, supporting near-term profitable segments while pulling back on ambitious bets that weren't yet generating returns. The playbook demands you stop scattering capital across a dozen speculative wagers. Instead, you double down on the one competitive moat that reliably generates cash. This isn't a retreat from innovation, it's the funding mechanism for it. Federal assistance through TARP provided the bridge GM needed. Operational restructuring then became the foundation for every calculated future bet, insulating long-term R&D from the violent swings of capital markets. The third rule attacks the very nature of capital allocation. One-time sales create a fragile, volatile income stream. The playbook demands improving cash generation and reducing uncertainty during transition. GM's expansion of digital services, projected to become a $3.1 billion annual business, is the blueprint. By converting a customer into a subscriber, you build a financial relationship that outlives the vehicle itself, adding a layer of armor to the balance sheet. These rules reveal the harsh duality of a true turnaround. The public wants a simple story of heroic recovery. The private reality is a series of unsentimental, painful decisions made far from the spotlight. Recovery is an operational act, not a press release. The GM playbook leaves every leader with one final, unflinching question. What is the equivalent of your profitable V8 truck engine, and what are you doing to protect it?
Learn the next winning strategy.